The argument of growth versus dividend investing is one that has lasted for as long as the concepts were a thing, and this argument is not going away anytime soon. I have seen people recently take hardline stances on whether they think one way is better than the other, however, I am not that radical. As an investor, I see the perks in high growth as well as high dividends, but in this video, I'm going to outline my thesis on why dividend investing is best for me and why it might be best for you as well. If you're a new investor or someone who is still unsure about their strategy, then this video might be for you, so let us get right into it. Before we start this video, make sure to like and subscribe if you're new to the channel because I will be posting dividend stock videos just like this one every few days. Let me just preface this video very quickly by saying there's no definitive answer to whether growth or dividend investing is better. Both of these investment strategies have their ups and downs, but I'm going to outline why I think dividends are the way to go, and also how you can incorporate both of these successful philosophies into your portfolio. Firstly, the biggest reason I invest in dividends isn't even a financial one. It's a mental one. The investment game is a long, arduous process that can put a lot of mental strain on a person. It is easy and fun to see your investments skyrocket, but it can also be seriously mentally draining to see your investments go deep into the red, and that is something that is bound to happen at least some point during your investing journey. Even legendary investors such as Warren Buffett make their fair share of mistakes, such as his investment and merger of Kraft Heinz, which has been an abysmal investment over the course of a few years. If you are investing simply based on growth, seeing your stocks go into the red, especially by 25% or more, can be destructive to not only your portfolio, but also your brain. However, for dividend stocks, these drops are seen a little bit differently, and in my opinion, are less of a negative than they are with growth. Firstly, dividend stocks, considering the underlying business is good, which it should be, pay dividends even during those red years, and because the stock is cheaper, these payments will reinvest into even more shares. This is good because even during bad years for the market, you are still adding to your position, which is always great to see and is very mentally reassuring. Because the shares are cheaper, drops like this are always a good opportunity to buy more shares under your cost basis and add to your annual income. The way I view my portfolio recently has not been in terms of its worth, because that fluctuates just so much, but rather based on its annual income, which for most investors should really only go up, and it is much easier to pay attention to without getting demotivated. The second reason is that, simply put it, I do not like the concept of having to sell my position in a company to make money. As a partial owner of a company, I want access to some of the profits, and dividends to me just make sense. Now, what I just listed aren't actual facts on why dividend investing is better, but I know for sure it makes investing for me a lot easier, as it's very rewarding to see your payments grow and grow, and I know a lot of you can agree. Just for an example though, I'm going to bring up Meta platforms for one of the reasons I don't really love growth stocks. As you can see by this chart, this stock has been an absolute roller coaster, and although it has provided some very good, definitely market-beating returns over the years, it has definitely probably caused a headache for a lot of the long-term shareholders. Let us say, for example, you bought the stock all the way back in 2016 for $132 a share. Now, overall, especially since 2016, this would have been a great investment and definitely market-beating. However, there's a good chance you might have sold the stock somewhere along this way. Just using this line and going over, you can see that pretty quickly in between around 2 years, you were up almost 60% on your investment, which was a great feeling for these shareholders. However, over the course of the next few months, this would drop to the negatives. Going from a positive investment of such a large percent to going negative is definitely mentally draining to see and to feel on your portfolio. From here though, the stock would pretty much skyrocket except for the dip, but this was caused by COVID, which basically every stock went through, so I'll ignore that. And the stock continued to skyrocket, which would have felt fantastic, and you would have felt like a genius for investing early. At its peak, you would have been up almost 200% up. However, over the course of the next few months after this, your investment would crash, all the way to your investment being worth over 30% less than when you bought it. Going from almost 200% up to 30% down would be mentally crushing, and there's a decent chance you might have sold on the way down, or even worse, you would have to sell on the way down because you needed the equity to pay for something. With dividend investing, firstly, most stocks don't seem this sporadic and are definitely not this random looking as Meta has been over the course of the last few years, as its beta has been out of control. And these large red instances of Meta underperforming, if it was a dividend stock, wouldn't feel as bad because you could load up on more dividend income and the company would still be paying during these poor times. Basically, the moral of this story, at least for me, is that dividend investing is a lot less mentally taxing as it feels a lot less random and is also just a little less risky. The second reason for investing in dividend stocks is because of, well, the dividend. Not only is the dividend a good mental concept, it also provides shareholders with income and cash without having to sell a portion of the company. A lot of people will argue that dividends are a negative because they trigger a tax event and that they end up taking it at the company's worth, but overall I think of them a bit differently. Firstly, the snowball effect is something that is very quick when dividends compound. Dividends are literally a compounding machine. It makes it so as time goes on, your dividends will get bigger and bigger automatically through both reinvestment and dividend hikes. Secondly, although there is a tax event, it still does free up some cash to either reinvest or to spend, which is the same thing as if you needed to sell some equity in order to buy something such as putting a down payment on a house, because that comes with tax as well. As I am personally planning to live off my investments one day, dividend investing just makes a lot of sense. Although selling my equity to pay for my expenses will happen eventually, I want to be able to live off my investments without having to sacrifice any of my ownership stake in the business for at least as long as possible. Another reason is that dividends are also a good metric for business performance. As I said earlier with the meta stock example, companies that pay dividends often aren't as shaky and are more consistent over the long term. This is definitely not always the case, but for many companies, just the fact they're able to pay a dividend, especially one that has good dividend history of growth and consistency, showcases that the actual underlying business is pretty solid. There are definitely some exceptions to this rule, such as Walgreens Boots Alliance, who has some fantastic dividend history but lacks pretty much everything else, but for the most part, I'd say this is pretty accurate. However, especially depending on your age, every portfolio does need exposure to growth, no questions asked, and that's something I do want to mention in this video. Unless you are already in retirement, living off of those sweet dividend paychecks, growth is necessary. That is why there is a fantastic in-between: growth dividend stocks. As the name implies, these type of stocks pay a dividend, normally a smaller starting yield, but also offer growth better than that of the S&P 500 if you choose the right companies. Some examples that come to mind are Visa, Microsoft, Apple, and Lowe's. These companies, although being growth stocks, still offer a good dividend or vice versa. The main metrics I think are important to look at are two things: dividend CAGR and dividend payout ratio. The dividend CAGR is the dividend growth, and this is an easy way to get over that small yield. For example, Visa stock currently only yields 0.78%, but the dividend has also 5x since 2015. That means if you bought Visa stock all that time ago with just a small starting yield of 0.7% in 2015, that current yield, also known as yield on cost, of those same shares would now be 3.5%. This is the single-handed best way to get access to fantastic growth and dividend income. These dividends may start out small, but because of their amazing CAGR, they build up quicker than you probably expect. The payout ratio is also important because the lower it is, the more likely they're able to afford more dividend hikes in the future. For example, Apple's payout ratio is currently just around the 15% mark, which is absolutely nothing. This company, although it's very unlikely, could definitely grow this dividend by over 100% if they really wanted to, though that probably wouldn't be the best decision. In my opinion, through dividend stocks with a low payout ratio and higher CAGR, you get the best of both worlds, exposing yourself to a little bit of both elements of what makes these strategies so successful. Anyways guys, I hope you all enjoyed this video. I decided to take a small break away from stock analysis and rather talk a bit about the broader picture. If you agree with my thesis, let me know, but also let me know if you think the opposite. I'd love to hear different opinions in the comment section down below. I will see you all in the next video. Goodbye.